Get started. All right, hello. So everybody, just as we're getting started, Cokes, Diet Coke, Sprite, anything you guys want over there. Cookies, please eat those because I will if you don't. So anyways, thank you guys for coming out. So Austin and I have been talking about putting together an event focused on home buyers, gosh, for a while now. And it finally, with LPT Realty and the beautiful conference room and all that, we're able to bring it, to fruition here. So the plan for today, we've got about an hour. So I'm going to talk about 15 minutes. Austin's got about 15, 20 minutes, and Q&A at any time. If you guys have questions, we don't need to save it till the end. This is very interactive. So we're going to go kind of a high level overview. But again, if you have specific questions, we've got financing here. We got me here. I've actually got Mia from the title office here. So any questions you guys have, be happy to help. With that being said, I like to start off and see what topics specifically do we want to make sure are going over today. Anybody have any questions on where they're at in the home buying process? And we'll make sure Austin and I touch on that.
Just understanding existing home contingent for purchase of a new home.
Okay.
You and I talked about that.
Perfect.
But I want to go over that.
Yep, and we'll talk about how an offer might look, contingent on financing, not contingent, bridge loan, things like that. So that's perfect. Great. What else we got? Omar, we were talking with Austin a little bit. He's going to talk about if you own your own business and how the financing might look for that. So I thought that might be pertinent for some of you guys in here. Okay, well, if you guys have any other questions, things you want to talk about, Gladys?
Are you going to cover anything about HO?
About like HOAs?
HOA?
Yeah, so we'll talk in regards to making sure you incorporate that into some of the numbers. So one of the things that a lot of buyers, they might be qualified to a certain amount, and you look at two different homes, a townhome and a single family home, and this might have a huge HOA. Well, now we got to adjust the values a little bit. So we'll definitely talk about that. Did you have any specific HOA questions aside from that you want me to cover?
There's a lot of things going on about new rules and regulations. They want to make the HOA accountable for any like hurricane damage, or that the owners don't have insurance, and they want to grow their monthly charges by the governor. I don't know if you have heard that or it's just rumors.
So there have been some HOA regulations that have gone into effect in the last couple of years. There's been some changes on, actually several of them have been limiting the power of the homeowner association as far as condos. So you'll see some information in front of you. We've got a condo that's actually listed for sale down the street from here. And the HOA just went up because of insurance and assessments. So I can definitely touch on that for you. Hadn't heard it as so much on single family homes, but definitely on condos and townhomes for sure. Okay, great. All right, so to start it off, welcome introductions about me. So everybody in here knows me. If you don't, shame on you. I'm pretty awesome. But so
He is.
I grew up in Central Florida. I grew up in Lake Mary. I was actually born in Columbus, Ohio. So I'm a transplant, but I've been here since I was about, 3 or 4. So I lived in Lake Mary, Volusia County, Seminole County. Hey, come on in.
Thank you.
Grab a seat. We got wherever you want. We got some beverages over here, notepads if you want to take some notes. We were just on the first slides. You haven't missed anything yet.
Okay, thanks.
All right. So I started selling real estate back in 2005. So 19 years ago, during the recession, I was working in the plumbing industry because houses weren't selling for very much. So actually a dual threat with a commercial background. And then when working in plumbing, I actually covered the entire Southeast at my last position and had 27 reps, 70 million in sales with commercial and residential real estate. So even though it wasn't actively selling, residential was still in the market and dealing with that a lot. And then when the market stabilized in 2019, I was able to get back into it full time. So I've been doing that for 5 years now, 100% real estate. And so, one of the things for investors, flippers, buying an old house, having that commercial and that residential construction background really, really helps out. And then we've got a GC in the room with Nate. So he's shaking his head back there going, yeah, you can really appreciate that when you go through it. And then I went to Florida State, but don't worry, if you're a Gator, I'll still help you. So fun fact about me, in 2007, I was on the Wheel of Fortune. You guys might have heard it. So I was the big winner for my round, but I did not get the final puzzle. The final puzzle was on the map, and it was ironically somewhere we were vacationing with my wife's family 3 months after Wheel of Fortune. So I'll never live that down, that if I paid attention to her more, I would have won another 25 grand. So, and then why I do what I do, my kids, I've got 3 kids. Everybody calls me Coach John in the Barry, because I've been coaching out there for 10 plus years now, soccer, football, track, basketball. My kids do whatever. So, all right. So that's enough about me. So, overview of the home buying process. First step, you want to see what you can afford. We can do this by either calculating different ratios, and this guy Austin's going to talk about all that. You can take your debt, your income, figure out what your monthly payment is, what your list price might be. So, but I'm not going to focus on numbers. That's going to be Austin's part. Then once we find out what you can afford, what your pre-approval rate is, we can start setting up the searches and going shopping. First thing to focus on is going to be location. So you want to start where you want to live first. That's the most important thing. You can get land, you can build a house, you can remodel a house, but you can't change where it's at. So that's the most important part to start with, is location. What we do on our end is we start setting up home searches, map criteria, the number of bedrooms you want, the square footage, the room count, and then we start setting up appointments and seeing homes. The next step after we find a home, submitting and negotiating for an offer. So that's one of the things that we handle. Right now is kind of a very funny market. The last few years have been a seller's market. There's been 5-10 times as many buyers as there are number of houses on the market. We're starting to level out a little bit. As interest rates go up, the number of buyers goes down on what they can afford. So that starts leveling out. We are still upside down. We still need more homes on the market. So you still might run into competition. If there's a home that's underpriced or in a great location, it might still have multiple offers. So getting the pre-approval, getting financing lined up, getting all your ducks in a row is going to be really key to get started in that scenario. Once you're under contract, you're going to submit an escrow offer, or submit your earnest money deposit into escrow, and I'll talk about that a little more in a second. We're going to order inspections, order an appraisal and survey, then we're going to finalize and secure financing. So let me kind of unpack a little bit of those. So with the purchase process, this is kind of an overview of what I was just saying. I like to say that you're going to need 2 buckets of money. So in the very beginning, when you are home shopping, you're going to need to make sure that you have saved up enough money to cover all the inspections you're going to do. So if you're going to get a property that's got a septic tank, it's going to have a well maybe, you're going to want to get a septic tank inspection. You're going to want to get a well inspection. Now, these are optional. You don't have to do these, but I'm going to highly recommend them because you don't want to walk into something that could be a $10,000 problem later on. So you're going to need to have that money saved up. You're going to do a general home inspection, and you're probably going to do a termite wood destroying organism inspection. All this adds up. It could be maybe $500 for a general home inspection, a couple $100 for the termite inspection, well, septic, another $300 or $400. So, you know, we're up over $1,000. So I think it's important to know what money you're going to need up front versus when you get to the end. So the other part of that I mentioned a couple of minutes ago is your earnest money deposit. So when you're making an offer on a house, you're going to put some skin in the game. So if you say, I want to buy your house for $350,000, I'm going to give you a deposit to let you know that I'm serious and not walking away. Now that deposit is yours to lose. One of my most important jobs as your agent is making sure that you don't lose your money. And one of the biggest first things is going to be that earnest money deposit. I typically recommend around a 1 or 2%, give or take. So $3,500 on a 350 house. You know, if you're going to go up to 7,000, there is no rule. There's no set minimum or maximum. If you're in a competitive offer situation, one of the ways that you can increase your competitiveness is to go ahead and have a stronger escrow deposit. So if we're comparing 2 offers on that same house and one's 350 with 1,000 and one's 350 with 5,000, that seller's going to say they've got more to lose if they walk away. So that's going to be a stronger offer. So that's just one little thing to think about. Again, financing, I'm going to let Austin talk about all that. He's going to introduce himself, and I probably should have introduced you in the beginning, but I'll let you take over in a minute. But there's going to be different ways to do financing. So We're gonna have veteran, Federal Housing Authority, conventional USDA. Again, he's gonna talk about those options for you. So what I was talking about with 2 buckets, so I kind of came up with this. So in that first bucket, we're gonna have all the money we're gonna need for inspection. So again, like we just talked about, could be as low as $500-600, could be twice that, $1,200. Your escrow deposit, that's gonna be in bucket number 1 as well. At the end of the day, when you go to the closing table, what you need in bucket number 2 is going to be your down payment money and your closing costs. So if you were going to do one of the loans, he's gonna talk about this, but if we have a 3.5% down payment on an FHA loan, you're gonna need 3.5% of the purchase price, which in the 350 scenario is probably $11,000, $12,000. So that's gonna be your down payment. Now, the cool thing about bucket number 1, that earnest money deposit, you get that back. Dump that into 2 at the end. So if you put $5 grand down, you're only gonna owe 7 more grand for that security or that down payment at the end of the day. So that's what I like to talk about with the 2 buckets. The other thing you're gonna need for your closing, in addition to your down payment, are gonna be your closing costs. Those are gonna be lender fees, title fees, property taxes, sales tax, title fees. So there's gonna be a list of fees. I like to say that normally averages around that 3 or 4% as well. So if you budget 3 to 4% for closing costs, and you've got the down payment of 3.5 or whatever the financing terms you go, that's all that money in that second bucket. So I'm gonna pause right there. So what questions do we have so far? I know high level overview, but in talking about everything except financing, what questions we have? Or it's all so clear that we're doing great. Good. All right, Tommy, back with us. Thank you, sir.
Talk about the third bucket.
All right, so third bucket I don't have. What's the third bucket, Freddie? Oh, okay. So turn your head sideways. So this is the house hunting checklist. When you guys are working with us, we actually have this, print this out, take this with you. You know, we go see 5, 6, 7 houses. I would turn the computer, but I don't think it's gonna do anything. It's not like a phone where it has a little thing in it. So when you walk up to a house, as a buyer, the first thing you're gonna see is the exterior, curb appeal, landscaping. If we go see 5, 6, 7 houses and you're trying to remember which one was which and you're looking at them, whether or not you use my house on the checklist, definitely take a notepad with you to the properties and jot down your notes. In the system that we use, our MLS One Home system that several of you are familiar with, you can actually make notes in there, kind of keep track of everything yourself. So whether or not you do it digitally or we print these out and give it to you, I definitely recommend that because you're going to see so many houses, especially with summer coming up, that it's going to, all right, which one was this one that we saw that had that fireplace that I loved? All right, which one had that wraparound porch and smelled like a litter box? You know, you're going to have to remember those things. All right, contracts and negotiations. So some of you have bought here before, some of you haven't. This is the fun part. So right now we were talking here, if I got my coffee in the middle of the camera there. We were talking about, I was talking with my clients about a home and you're trying to find the right number to make your offer at because it's still a seller's market, but it's kind of averaging out like we talked about in the beginning. So do we want to go in really low and make a low ball? Is it a fixer upper? Is it exactly what we want? Are we going to go in at the list price? So that's where it kind of comes into play. And every scenario is going to be different. Every home is going to be unique. So I met with a client yesterday looking at listing their home down in Kissimmee, and we were talking numbers. So we were in the range of, if you want to sell really quickly, 425. If you want to try to maximize and maybe see what happens, let's go in at 435 or 440, try to get a little more money. From the flip side, on the buyer side, it's almost a psychological guess because I always try to figure out, okay, where's their mind at? So they bought the home 4 years ago. The market was this, it's appreciated this much. They've maybe done some repairs and try to figure out where they're at. And then you can go in and say, okay, it's been on the market for 1 week, probably not going to go in 100 grand less. Been on the market 6 months, maybe some wiggle room in there. So we'll handle every situation unique and go over that together. And then we'll do all of the paperwork. I handle all of that with you. I won't go into the paperwork today, because that's when you get to that point, we'll read through it all together. And then go back and forth with the offers, and once something gets accepted, we move forward to the next step. Now, I will tell you, with contracts and negotiations, one of the things that we will always try for on the buyer side is to get you every dollar or everything we can up front. So some of those closing costs, we might ask the seller to contribute towards. So it might behoove you to go in at offer price at $350 of what they're asking for, but ask them to give you a concession to help with some of those closing costs, to help with the taxes and fees. And they might say yes, they may say no, and we go from there. That's part of the negotiation process. Oh, one thing I do want to point out, the state of Florida, majority of contracts are on the as is. So you have the right to inspect the property. You can purchase the property as is. After we do inspections, you can accept them as they are. You have the right to walk away. You retain your security deposit. Or we can try to enter a negotiation and try to get repairs or something else. Again, as is with right to inspect, neither side has to make any agreements, but most of the time, if they're reasonable requests, we can come to an agreement. Questions on contracts or negotiations?
So let's say we put in an offer and the house doesn't pass inspection on reception.
Okay.
So we lose our earnest money, or?
No, that's a great question. So let's dive into that a little deeper with past inspection. So depending on the loan type that you get from this guy, there may or may not even need to be an inspection. So if you're going to get a conventional loan, you're not going to even have to inspect that septic tank. Now, he's going to give you the money whether or not you do. Now, I'm going to recommend that you do inspect it, but it's not a pass fail. It's a, do I like the inspection report I got, or was there an issue? Now, here's my philosophy on as is. If you saw it while we were looking at the house, we're not going to ask for it after inspection. It should be part of our offer. If we noticed that the home needs a new roof, we know that going in. The roof is 20 years old. There's water stains on the ceiling. The seller knows it needs a roof, but he didn't really adjust the price to reflect that. So we go in and we're going to say, hey, we know it needs a roof. We've reduced our offer, or we're asking for cash back at closing to reflect that. We know going in now after the inspection, we're not going to ask for that. But let's say the seller didn't know that the septic tank had an issue. And we go to them now and say, hey, we did the septic inspection. The safety switch on the motor didn't work. It's going to cost about $500 to fix that. We'd really like to see if you can fix it or give us that credit so we can fix it. So that's how we would handle that kind of situation. Now, if we found out that it needed an entire new drain field and it was going to cost $5,000, that's a much bigger issue, and we would definitely want them to help us with that, or we might walk away. Now, the second part of your question, going back to most important part of our job is to save your money. We're going to make sure that all of the inspections happen in the allowable window, so that if we cannot agree to future terms, you do get your earnest money deposit back. And that's part of your contract offer. So we would offer 7 days, 10 days, 15 days as part of our offer to give us that time frame to do those inspections. So, but no, that's a good question. So in that scenario, if you do decide to walk away, you get your earnest money back, but you've paid for those inspections, you don't get back. So that's your out of pocket to consider. A good question though. Any other questions on that? No? All right. So then really the last steps, kind of going from once you're under contract all the way to the end, first thing we're going to do is we're going to deposit your earnest money. Deposit your earnest money to escrow. That's going to be typically at the title company. We will schedule inspections like we just talked about. I will be at all the inspections. You do not have to be there. I highly recommend that you are, so that you can shadow the inspector, ask questions, go over the report. We're going to present that seller's disclosure, go over all of that. We're going to go over the inspection reports together. And then if you want to get any quotes on any of those things, we're going to connect with one of our contractors and line up some quotes for you, and do all that during that window so that you know and make an educated decision whether to move forward or not. Once we move forward and we have agreed upon terms, the next step, the lender is going to order the appraisal for us. So one of the things I was talking about actually yesterday with the presentation was appraisals versus value. You might come onto a property and it might be 10 acres of land and it's got all kinds of stuff on it and you value it at X. The appraiser may value it higher or may value it lower. The appraiser is what the bank's going to lend you money based on. 9 times out of 10, the appraisal is going to come in at or near your purchase price if your realtor has done a good job evaluating the property for you and making an offer. So that's the appraisal. Now, if the appraisal comes back high, you have built-in equity. If the appraisal comes back low, I've got to go back to the drawing board with the seller's agent and we've got to renegotiate those terms. Or you have the option of paying the difference and, saying, hey, it was $5,000 low, I'll pay the $5,000 out of pocket, that kind of scenario. So, but Austin, how many times would you say an appraisal comes back at value versus not?
Well, it's a little different for us. We have our own team of appraisers that we've worked with for about 2 decades now. The appraiser team we work with is very, very aggressive. They're great at what they do. I mean, we probably hit 99% of contract prices of what we see. So very, very rarely do we see an appraisal come in lower than what the contract's executed for. More often than not, they're coming in higher.
And most of the time with ours, they come in higher, as he knows. He's always sending the "you got equity, great job, John" email.
Pretty much. So, but they do a great job, and obviously they can't just put any sort of value on an appraisal report. They do have to substantiate their work. There has to be legitimate sales that they can bracket their values within. So I mean, it's real work's being done. They just do a better job of being more aggressive in their approach. This way, our buyers aren't stuck with potentially coming out of pocket with extra money to bridge a gap of short value, for example. So in essence, it benefits.
Yeah, you would never want to have an appraiser fluff something because that's your loan. Now it's extra money you got to pay for. So, and then just wrapping it up. So the next, go ahead.
Is that not what the value of a home is? What somebody's willing to pay?
So that's
generally
yeah, and so that's
willing to
the
pay
perfect question.
an extra $5,000 more, and while you did your analysis and it might have been maybe $5,000 under, they're willing to pay $5,000 more. That's the value of the home according to that person.
And in that scenario, see, that's a perfect point.
The appraisal should come in at $5,000.
And if the appraisal comes in $5,000 less, because it's based on the other properties that have sold nearby that are the same age, same size, etc., and you value the home and you pay the $5,000 out of pocket, the next appraisal on the property down the street is going to be based off of your purchase price. So your value, even though the appraisal was lower than where you valued at, Freddie's exactly right with the point he's making. Now that's the value. Somebody paid it, it closed at that. The appraiser who does the next appraisal down the street and uses your home doesn't know you chipped in $5,000. He knows that you value that home at $455, and that's what they use for the next one. So it's kind of self-serving in that regards. If you do end up paying a little bit more, again, we don't want to make you pay more than appraisal by any means, but in a competitive situation, if that does come up, that would be something that we would, definitely to talk about with you. And so that's pretty much it. The last couple of steps are just paperwork steps. So we would make sure we have all the documentation. I've got a transaction coordinator, Jackie, that's awesome. So she makes sure that I don't miss anything. All the T's are crossed and I's are dotted. Then we would help you shop around for homeowners insurance policy. You got to get that set up. And then we'll get everything over to the lender. The last step on the lender side, he gives us a clear to close. And then you're ready to go. You get your funding, you do your final walkthrough, buy a house. That's what I've got. Now, Mr. Austin, you want to take over, switch over to your guy?
Sure.
While he's doing that, you guys have any other not financing related questions? No? All right.
In the state of Florida, who pays the title, the buyer or the seller? So.
That's the customary. Now, of course, one of the things I always like to say is everything's negotiable. So there is a spot on the contract where you can, with your offer, say the buyer wants to pay for the title and the buyer wants to choose the title agency. It's not very common in Florida because that's an extra buyer expense. I see it mostly when the buyer is an investor with an LLC because they typically have a title company that in-house or that they work with, so they get better pricing. So aside from that, it typically 9 times out of 10 is going to be the seller.
The question
Well,
I have,
the distinction on that real quick. So the seller typically, like he's saying, chooses the title company that's representing the transaction.
That's what my
And for having the title company chosen by the seller's paying for the owner's title policy of title insurance. There's a lender's policy of title insurance that protects the lender in case title didn't do their job correctly. That's actually paid by the buyer amongst their standard overhead fees.
That happens.
Yeah.
Correct. That's normally how most transactions are conducted. Now, if in a rare, let's say you're going to go buy new construction. New construction, on the flip side, they don't typically pay the owner's title policy of insurance. That's paid by the buyer, even though you're still using the title company. There's also some governmental charges, like dock stamps on the deed, that are typically paid by a seller for allowing them to choose their own title company. In a builder's situation, new construction, that's not paid by the builder. Closing costs typically on a resale, as John mentioned, and I'm sorry, I'm kind of going off on a tangent. I'll introduce myself in a second, but closing costs typically on a resale transactions, generally around 3 to 4%, like John said. However, because those fees aren't being paid by the builder, in a new construction scenario, you're typically looking at 4 to 5%. So it is more when you go to buy new construction for that reason. And you had another question. I interrupted you.
No,
Good.
I'm asking later about contingencies.
Oh,
Oh,
yeah, that
that's
was one
right.
of the
We were gonna
questions
talk
we had.
about contingent, so we'll make sure that we cover that.
Absolutely. I'm in the way of my own presentation. Sorry about that. Well, good afternoon, everyone. Some familiar faces in the crowd. Appreciate that. And thanks for you guys taking your time out on a Saturday to learn and to be more educated on the home buying process. I'm happy to give you as much information as possible. So I'm Austin. I'm with Local Bank, and I'll talk to you a little bit about who Local Bank is, who I am. Should get into the agenda here. Ooh. So we're going to talk about who Local Bank is, obviously who I am. I'm going to talk to you a little about the value that we bring to you as a client, and obviously talk about our products and services that we offer and the home buying process from the lending side. John did a great job at giving his roadmap from the real estate side. I'll give you our roadmap from the lending side as well. Perfect. So thank you.
I got you, bro.
I appreciate you. So who is Local Bank? So Local Bank is an Alabama-based bank as of right now. We have about 4 branches. We're about to bring on a 5th and a 6th in the next coming month, all in Alabama. They're headquartered in Tuscaloosa. But in the next 6 months or so, we should be opening up our first branch here in Orlando. We own a building in College Park right now. So obviously, if you wanted to meet face-to-face, we would meet there. But reason why I mention it is there's a chance when we open up our first branch that becomes a cashless bank branch where you walk in, if you need any services, if you need to deal with anything in cash, there's an ATM outside, that type of setup. The other option is we may sell the building and build a traditional bank branch with a drive-through and a vault and all the things that you're used to seeing in a normal bank branch. So back and forth, I'm not really sure on how that's going to work, but in the next 6 months, we'll have our first bank branch here in the Orlando area. Not sure where just yet, if we have to go outside of the building that we own. As far as how our structure is, everything we do is in-house. So we use our own underwriters, they're in-house, our own processors, our own closers. And as I mentioned to Freddie's question, I believe it was with the appraisal, we have our own team of appraisers, and they do a great job, as I've already mentioned. They're literally an extension of our team and provide a lot of value to your transaction. No pun intended. So we certainly do mortgages. I've been doing mortgages since 2005, similarly to the same year that John started in the industry. That's obviously my bread and butter. But at Local Bank, I actually am a full service banker. So if you guys are in need of personal banking, business banking, commercial lending, credit cards, auto loans, CDs, IRAs, money markets, secured credit cards, all of those instruments we also offer as well. So. And then a little more about me. I've been in the Orlando area since '95. I started mortgages in '05, as I mentioned. I don't like to toot my own horn, but I've been a top producer mainly when I was with a different institution, but all the way up until 2003. I've helped thousands of families buy homes in my career. I'm a husband and a father of 3 kids. So my life's pretty busy at the moment. They're all under 7, so.
Ooh.
luckily-
3 under 7.
Luckily, my wife was gracious enough to watch them all here. I have a team I work with.
We had soccer this morning, right?
Yes, soccer this morning.
I had football this morning. It was bright and early.
Always a fun time. And I also have a team I work with. Between them and I, we're a well-oiled machine. Basically, the people on my team were picked for their strengths and what they do well, so we can help balance each other out throughout the transaction. The nice thing is even though I have a team, whoever I work with, they speak with, as far as a client, you guys would speak with me throughout the whole process. Responsiveness and communication is key to make sure that you guys have a great transaction, whether it's Saturday or evenings. We're happy to help and be responsive to your needs and create a great mortgage experience for you guys.
If I could add one thing to that, so it does not matter to a realtor what lender you work with, because it does not affect our paycheck at all. It's 100% the best person for you, your local bank, pun intended. But what I will say is this, the way it does matter to me is when something needs to be done and you're using that 1-800 number that you saw on the commercial, and they're there from 8 to 5, Monday to Friday, and it's Saturday, and you're supposed to close on Monday, and I haven't gotten any documents. Well, I can text this guy. He was texting me at 10:30 last night. So, I'm not saying I'm gonna work at 10:30 every night, but I'm texting
Don't
this
sign me
guy
up for that either.
to get something done. We're gonna get it done for you, So while we like Monday to Friday, 8 to 5, we realize that our customers, our clients, they need our help when they need our help. So for me, if you work with a local guy who I can get in touch with, that does make my life easier. So in that regards, it does impact me. So that's why I like working with guys like this.
Well, I can tell you, having 20 years of experience, having worked with many, many families over the years, having a presence locally here, somebody that knows a lot of different people in the industry as well, working with a local lender also helps give you a competitive edge when you offer on a property. I know a lot of agents in the Orlando area. I'd like to think I have a good reputation in the community. Those types of things also help you give a leg up when submitting an offer to a seller. So, for example, you have 2 offers, they're exactly the same. One's with a large bank that's everywhere, and you're kind of being order taken by them. The other's with a local lender, more personalized presence. You're probably gonna have a better chance of getting that offer accepted, working with a local.
And I'll tell you how many times I get the other agent on the phone and they say, "Oh yeah, I know Austin, great guy. He's helped me with so and so and so and so." You got a leg up right then. Absolutely.
So what is the value that we bring to you as a client? So again, I mentioned you speak with me throughout the entire process. I don't just get you pre-approved, you get under contract and then walk away from the situation. I'm there throughout the entirety of the process. As we mentioned, evening and weekend availability. We're fast. I can close a loan in as little as 2 weeks if I need to. Our average is about 3 weeks currently. We do a diligent job in pre-approving our clients. So a lot of people have a misconception of what a pre-qualification is versus what a pre-approval is. A pre-qualification is, hey, I'm going to take your information over the phone, and based on the information that you have verbally told me, I'm going to give you a letter. That's not how we operate, because it's a flimsy way to pre-qualify a client. That's just saying, hey, I believe what you've told me, and based on what you've told me, here's what I think you would be able to afford. We take it an extra step and gather up all of your documents. Not all of them, but a short list of documents to ensure the accuracy in what we're qualifying you with has been done diligently, which means more and gives more validity to saying, here's how much you qualify for. Can't remember who it was. I think this is a good time to bring it up. That talked about max affordability. Can't remember who. If you remember.
I might have said it.
It's possible. So
I talk a lot.
when we pre-approve you, and we're trying to max out the amount that you qualify for. This is always a conversation I have with clients. So I think it's good to bring this up to you guys. We have to put a max price on the letter that we give you. But when we max out what your debt to income ratio can afford, it's not actually a max price, even though one goes on the letter. It's actually a maximum mortgage payment that you can't exceed. John mentioned you look at homes, some have high HOAs. For example, you're looking at a condo or a townhome. Single family, maybe there's no HOA, maybe it's a low HOA. we're going to pre-approve you up to a max mortgage payment with a suggested price on the letter. That means that as you're looking at homes with John, this is a sliding scale. So as the criteria of the home increases and decreases, meaning price, taxes, estimated insurance, and HOA, as that goes up and down, so will your actual max price that you can afford. So when I pre-approve you, it's not just, here you go, here's a letter, and here's the price. It's, here's what we assumed for the property at 400,000. We assumed 400 in taxes, 200 for insurance, a $50 HOA. That way, when you guys go out and look at homes, you can use those assumptions versus what you're actually seeing out in the marketplace. Does that make sense, or am I losing anybody on that? Any questions first of all, because I haven't asked that. Good, okay. We talked about the panel of appraisers, and then one thing I want to mention to you guys, this is also not, at least from our standpoint, it's not just, hey, let's get you pre-approved. What we also have available are buyer consultations that give you an in-depth analysis of the market, an in-depth analysis of how resilient real estate is, what's forecasted to happen with interest rates. We can talk about different pieces of the economy and cycles that we go through as a government and economy as it relates to forecasted interest rates and the housing market overall. What we want to do is make you a bulletproof buyer. We want to give you all of the knowledge that we can to make you, to give you all the information we can to allow you to make the most educated, informed decision possible when buying a home. I'm going to give you guys a glimpse of what that looks like. But one other thing that I forgot to mention that I'm noticing. So we can absolutely get you guys pre-approved, but what we also can do to add some extra value to help you compete with a cash offer is actually provide pre-underwriting at the time of pre-approval. What does that mean? So typically when we pre-approve a client, we're going to ask for income and asset documents to fine-tune the accuracy in which we're pre-approving you in, right?
Tax returns, pay stubs.
If you're self-employed, it'll be tax returns. If you're W-2, it'd be your pay stubs and W-2s. You'll need your account statements for funds to close, driver's license, things like that. If you own properties, you'll need to document the expenses of those properties as well. But in taking this a step further, and this kind of goes into some of the buyer consultation presentation that we have available, but 39% of homes sold for cash in Orlando last year. How do you guys compete with that? You can get pre-underwritten. What does that mean? We're actually, because we use our own underwriters, we can actually have your file pre-underwritten by my underwriter, and they will sign off on your income and your assets. What that does is that allows John to remove the financing contingency from your contract. Because once my underwriter signed off on your income and assets, all you need at that point is title and appraisal to complete a loan. So it makes your offer that much more competitive in the marketplace.
So it's not a 30-day, 45-day, 60-day offer. It's, hey, we're already pre-approved, pre-underwritten, inspection, appraisal, close. So we now are a cash offer essentially from that regards. So definitely a real strong point to consider.
We like the buyer, seller likes 2 or 3 weeks to close. They want
Sometimes, yeah, sometimes it's a vacant home, they want to turn it over like that. So, any scenario, absolutely.
positive.
If it's, they want it done in 10 days, they want it done in 20 days, he's ready to go.
Yeah, we can close in 2.5, 3 weeks, even
Yeah.
without pre-underwriting. But I think the pre-underwriting is a nice touch to be able to remove that contingency, makes the offer look that much stronger.
For sure.
And I'm going to give you guys a glimpse of what that initial buyer consultation market analysis looks like. So just to give you guys some facts about real estate actually has a 90% success rate. Appreciation started being tracked in 1942. If you count all the years since 1942, 73 of those years we saw appreciation. Only 7 years we actually saw depreciation, and there was 1 year of neutrality. I mean, 90% is pretty strong. I guess I was a batter in baseball, and I got on base 90% of the time.
Hall of Fame is like
Yeah.
a batting average of 350.
I mean, it's pretty strong. And if you look at the decade totals all the way to the right, I mean, it's 100% success rate. You look at holding real estate over a long period of time, you are guaranteed to win. Even in the years where we saw depreciation. And I think that's where sometimes a lot of buyers can be fearful of is, I relate real estate to this crash that we had in '09, and I'm pretty fearful of that. So another thing I wanted to give you a glimpse of is why right now is vastly different from the set of circumstances that we were in back then. Someone else talk about that.
So don't wait to buy tomorrow because the market is not gonna go down.
Correct. And in my initial consultation, when we talk about, real estate and market analytics, we go into a lot of that and why real estate is going to only continue going up. So if you'd like to learn more about that, please feel free to get with me and we can set up a time to do that. Variables that we had back in the mid 2000s compared to right now, you look at the amount of jobs that we had back then, or the lack of, the amount of unemployment we had back then rather, versus what we have now. It's a vastly different scenario. The amount of jobs that were available in the marketplace was far less than what we have right now. Back when I got in the industry in the mid 2000s, there were loans that were offered at that time called subprime loans. And for those, I'm sure there are people in this room that know what those are, but some that may not. So first of all, who doesn't know what a subprime loan is? Okay, perfect. So what is a subprime loan? Essentially, the easiest way to explain this, I saw a smirk back there. So if you had a pulse in 2005, you could get a mortgage. Well, man, how was that possible? So you could tell me that you would sign a letter that says, hey, I babysit my neighbor's kids for $10,000 a month. I'd say, thank you very much for your income verification. Here's your loan. So that's the type of industry that took place back in, or type of business that took place when I first got in the industry. Now, since then, our industry's been very, very heavily regulated, and we're a lot different now than we were back then for good reason. But essentially, they were very prevalent back then. Well, guys, think about it this way. If everybody qualifies for a loan, essentially everybody, how do I meet that demand? Well, as new construction, you can see this 5-year cumulative new home construction. To meet that demand of having such a large buyer pool, I have to build a tremendous amount of homes to keep up with that, right? Well, there were loans out there that weren't very good and people out there getting these loans that really couldn't afford these mortgages. So when these defaults, these mortgage delinquencies and homes in foreclosure started happening, these people stopped paying mortgages, and now my buyer pool, my pool of buyers shrinks massively. Well, if I have all these homes that are available now in the marketplace and I'm a seller or I'm a builder, how do I get rid of those properties? I have to drop prices. This is why we saw this is a big reason why we saw a housing crash. There's other reasons that go into it. And again, I'll save some of these information nuggets for our buyer consultation if you'd like to have one. But these circumstances that we had in the mid 2000s, they're nothing like they are right now. As John mentioned, inventory is much less.
They're 80% less.
Yeah, our inventory is completely different right now. So we're not in the same circumstances that we were back then. Does any of this information surprise anybody? I know for some people it definitely does.
Well, this goes right with what you said, Freddie. This is why the market's not going to crash tomorrow. If something else happens and we go to war and the whole world changes, we can't predict that. But based on comparing 15 years ago to now, it's nothing like it.
Is there an equivalent of a subprime loan today to be aware of?
No. So with having our industry so heavily regulated now, everybody has to actually document their income. With a caveat to that, you have your 4 major loan types, and we'll talk about different loan products here in a second. You have conventional, FHA, VA, and USDA. Those types of loans are for full income documentation, full asset documentation. You have to be under certain debt ratio thresholds. You have to be over certain credit score minimums, right? But John mentioned self-employment. I believe he was referring to you guys, if I'm not mistaken. But with self-employed buyers, okay, we would use tax returns to qualify someone that's self-employed. That would allow you to fall into the conventional FHA, VA, USDA program buckets. Now, a lot of times, self-employed clients write off a lot of their income on their tax returns. On their tax return, they might gross 100 grand in sales or 100 grand gross revenue. But when you factor in deductions, write-offs, expenses, now I really am only actually net profiting 30 grand, right? Unfortunately, well, fortunately from the IRS's perspective, that's a great thing. You owe them less money. Unfortunately, when it comes time to getting a loan, that's a problem. You show less income in qualifying. However, to this gentleman's point, there are other loan buckets we can put you in for being self-employed and not showing enough income essentially on your tax returns. And they're called non-QM loans or non-conforming loans or B paper loans, if you will. Now, what do I mean by that? So these loans aren't backed by large government agencies like Fannie Mae, Freddie Mac, FHA. Instead, they're underwritten and insured by a private investor. The private investor is going to underwrite, instead of tax returns for someone that's self-employed, they're going to underwrite the business's bank statements, for example. Or they can take a 1-year profit and loss statement for your business and use that to qualify your income. Or they can take your most recent 1099. Because again, your 1099 as a self-employed person is going to show your total sales. It's not going to show what your actual net income is after deductions, expenses, write-offs. They have creative financing options. Now, to his point as well, these aren't necessarily subprime loans because they're going to require a higher down payment and a higher interest rate for the mortgage than your conventional FHA, VA, USDA loan. They are going to underwrite the file, make sure that you qualify, but they are going to ask for more skin in the game and a higher interest rate. So to your point, they're not subprime loans, but they are creative financing options, that are out there. I have no income loans as well. Like that kind of brings back some of the subprime financing that was there. But for these no income loans, it's for an investment property where you don't have to show any income, but the property has to rent for more than what the mortgage payment's going to be. So there's ways to cover
A
yourself.
whole bunch of different options. Yeah.
Yes,
Most in my head is when you're new to self-employment, so how does that kind of affect?
it's a great
your
question.
qualifications?
Absolutely. So if you're new to self-employment, so when you are self-employed, you have to have a 2-year history of running a business. Or if you switched from one business to another business, it's the same industry. That can work in some instances. I'd have to kind of dive into that scenario, but for the most part, you need a 2-year history of being self-employed. So if you are new to a business, that is going to hurt your chances in qualifying because you don't have that 2-year history on tax returns. Now there's a workaround to that. So let's say somebody comes to me and says, "Hey, Austin, I just started this business." I would say, "What do you think about switching back to being a W-2 employee?" And then you get me an offer letter for a W-2 job. We could potentially use that instead of qualify. Or you'd have to wait the 2 years, for that business to show income on taxes. Or you could add a cosigner to the loan. We have options. But yeah, that does hurt.
Is it W-2, you need what, 3 months, 6 months, a year?
So I don't even need you to start a job on a W-2. So let's say you're in college, right? And you graduate and you're going to start a job with Lockheed Martin in July, okay? You get me an offer letter for that job at Lockheed Martin, and we can actually use that offer letter to pre-approve you and to close on a conventional loan or an FHA loan, for example, provided that you meet the reserve requirements from the time you close till the time your job starts. Meaning, I'll give you an example. Say you're doing a conventional loan with me, you're starting this job in July, you want to close in June. That's fine, but we're going to require 6 months reserves on top of your down payment and closing costs. Meaning, we take your new mortgage payment that you're going to take on, we multiply that by 6, and we need to see that in a bank account, IRA, 401k, stock, mutual fund, some sort of account, in addition to the down payment and closing costs that you would need to bring for the transaction. So you don't even, to answer your question, you don't even have to be on the job yet.
Yeah, actually, the first house that I ever bought, I started my job Monday and closed on my house Friday. So I had done the pre-approval with the W-2. And just to keep us on track of time, it is about 2:55. So I know he's got some good stuff to go through. So if anybody does need to leave, you're not gonna hurt our feelings. He's got a couple more slides though with some good information on it.
Start to go pretty quick. This is just more of the market analysis that I go through on a buyer consultation. This basically charts mortgage interest rates since 1955. The red line is your 30-year fixed mortgage rate. The blue line is the federal funds rate. We talk more about the differences of what those are. but essentially they're in lockstep with each other. But the other key piece of this is, look at the pattern that we see here with mortgage rates. Up, down, up, down, up, down, up, down, up, down, up, down, up, down. Where are we at right now? We're up. What do you guys think is gonna happen in our next
It's gonna go
step?
down.
It's gonna go down at some point. So,
But even look where it's up to is still lower than
1980.
all of these.
well, sure.
The only thing that's higher than is this right here.
That's because everybody remembers the past. 10
Everybody
years.
remembers short-term memory,
Everyone
right?
remembers the last housing cycle,
Yeah.
for sure. So, gives you an interesting snapshot of where we're at and where it should be going. I will ask this rhetorically to keep this in your mind. What do you guys think happens to the housing market when mortgage rates go to 5% on a 30-year fixed?
More buyers.
More
Right.
buyers equals more
competition.
competition, equals
Seller's market.
much higher prices. And our consultation goes into some of those analytics. We can talk more about that when you guys would like to meet one-on-one. So products and services, as I mentioned, we offer your main loan types, conventional FHA, VA, USDA. We talked about some non-QM loans. There are other non-QM loans I can talk about. Refinances, new construction loans, home equity lines of credit. We also have first-time home buyer programs. We have some nice grants out there and low and no down payment options. And we also have banking options. You know, as I mentioned, personal business banking options available for you guys too.
So would you say that you do more conventional FHA? What's your most loan type?
Conventional and FHA are typically your two main loan types that people will typically get from me.
The difference between them?
So conventional is your best type of loan out there, unless you're a veteran. Veteran gets the best loans because we love our veterans. But if you're not a veteran, then conventional would be your next best bet. FHA loans typically are reserved for people that can't qualify for conventional. Typically, whether you've had an economic event in the past or your credit score is lower, which we have options to help repair credit for you guys, by the way, if that's a concern, with doing rapid rescores where we can update credit bureaus in a couple of days by doing some different things on your credit report. We can cover that during the investigatory stages with you guys. But to John's question, typically conventional and FHA are the most that I see.
Now USDA, do you want to touch real quick on the down payment? Just because we do have people who are looking in USDA eligible areas.
Sure. So USDA is a property-specific loan type. So you have to be buying in a certain area that is eligible for USDA. You can Google USDA eligibility and search different areas of the map that are eligible. With USDA, you also have to be income eligible. With USDA, you can't make too much money. If you make over their income limit, you won't qualify for it. It goes off of household income. And then the third piece, the structure of the USDA loan itself, it's a zero down mortgage program. So it's 100% financing. Interestingly enough, this is the only loan program that will let you finance your closing costs into the loan. Now, to do that, your appraisal has to come in higher than the purchase price, which we don't know that at the time of pre-approval, obviously, or even once you're initially under contract. But if the appraisal does come in higher, that allows you to finance that difference of your closing costs into it.
And USDA, Department of Agricultural, just what you're thinking, it's more rural area. So you guys are looking out in a rural area, a bunch of land, et cetera, might be a great loan type for you. Again, 100% financing, no down payment. You only have closing costs and maybe finance those. So definitely keep that in mind. If you are looking in rural areas, let's make sure we check that map for you.
Any questions? Yes.
Yeah, excuse me, how come some of the realtors or the real estate, they never talk about first-time home buyer? I just bought a house for myself 2 years ago,
Congratulations.
and it was the first-time home buyer, nobody mentioned, so I just lost it.
I'm sorry to hear that. Maybe we're talking to the right people, I guess. I don't know. They should have mentioned it, but
Yeah, no,
So what kind of first-time home buyer programs through a bank would you say are opportunities to look at?
so first of all, let's talk about what the definition of a first-time home buyer is. So first-time home buyer is someone that has not owned a property that they've lived in in the last 3 years.
That's this right here, FTHB.
Sorry, first time home buyers. So I cannot have owned a primary residence that I've lived in the last 3 years. So as long as you meet that criteria, you are considered a first time home buyer.
So you could be buying your 5th home, but you're still a first time home buyer? Okay.
So most people don't realize that. So I want to make that distinction. So the second piece of this is, what do you get for being a first time home buyer? Well, there are low down payment options, as low as 3% on conventional, 3.5% on FHA. But there are also no down payment options where you can use a grant or a bond of some sort to help subsidize that down payment, where you don't have to bring a down payment. Still have maybe some closing costs that are involved. It's not necessarily a cure-all with some of the programs that are available, but it's a nice way to help get you into the home with less money. Sometimes there'll be strings attached with those programs, whether you have to pay back the assistance that was received, if you're doing a no down payment, for example. Sometimes you're taking a higher interest rate for those programs. There's agencies that set forth certain programs for first-time home buyers. Each program that's out there have different qualification requirements, different strings attached. What we like to do is have you guys go through our pre-approval process, figure out where you stand, and then based on your qualifying criteria, have a conversation with you when we're ready to put the pre-approval together that says, here's the options that you have, here's the good and bad of each of those options, and then let's collectively make a decision on what you guys feel would be best for you.
Yeah, and on the realtor side, one of the things that I have through my website and all of my MLS stuff is we have an eligibility calculator that does show a lot of county or state programs that you might be eligible for, and then through the bank as well, or they have their own programs internally at the bank with down payment assistance. So definitely multiple options there. That's a great question, Suma. But so I apologize that didn't happen in the past, but from the realtor side, from the lender side, we definitely want to explore those options. And so I have those links. He's got his information. So you're covered working with us on both sides.
I actually have a great grant program right now. It's so there's no repayment required. There's no hike in interest rate for it. It's $5,000 off your down payment. It's not repayable at all. It'll give you $5,000 plus $500 towards your appraisal and $500 towards your home warranty. And it's not based on the area in which you're buying. It's based off the address of where you actually live right now. It's conventional only, but it's a great option.
How do I prove I'm not living at my home if I didn't change my life?
So he's got a unique situation.
So when you fill out an application, you would put the present address in which you're living, even if your documentation states otherwise. And then we would get a letter from you explaining why your documentation shows this, but your application shows that.
Okay, so pretty easy.
And we would run off of your present address, not the address of your documentation. Questions so far? This just gives you a roadmap of our buying process, of our loan process, I should say. So again, we're going to do the application and pre-approval. We'll pull your credit during that process and gather up that initial set of documents, maybe a little bit more if you guys choose to do the pre-underwriting versus the pre-approval. And then you guys get with John. He gets you under contract to buy the perfect home. Then we're going to process your file. We'll do a formal loan application during that time. Have my team process your file, scrub it, make sure there's nothing else that's needed before it goes to one of our internal underwriters. They underwrite your file and issue a conditional loan approval. A conditional loan approval says, hey, we're going to give you a loan, but you must satisfy the following conditions before it being a final approval, or the magic words that everyone loves to hear is clear to close.
So this goes to Nate's question on the conditional approval. So could you give an example of you're a current homeowner conditionally approved to buy a new home?
Yes. So contingency and contingency versus non-contingent pre-approval. So how we would operate that situation, there's a few different options that you have. The best way to go about it would be your income is enough to support the current mortgage payment that you have on the current home, plus the new mortgage payment of the home you want to take on, plus the debts on your credit report. As long as your income substantiates those three facets of debt, we're good to go. That's non-contingent best case scenario. Next non-contingent best case scenario, there are options out there to where you can, there are some sell before you buy or buy before you sell programs. You pay a fee, They give you the equity capture of your home. You take that money to buy another property without having to sell your current, but you do have to sell your current within 90 days after you buy the new home. There's those options out there. The other option is, let's say you don't want to sell your current home, but you want to qualify to buy a new one, but you maybe have some income issues with qualifying and substantiating both. We can show a lease for rent on your current home and count 75% of that rent amount to help offset your mortgage payment on your current home and to make the income look better to qualify for both. That's another option that's out there. And then you can also do a bridge loan. We actually offer those bridge loans as well. So a bridge loan allows you to just, instead of paying the fee for the company to give you the buy before you sell, we would offer the bridge loan with no monthly payment required until you actually sell and pay us back. You owe interest at that time. It's usually like a 12 or 18-month balloon, but we give you the balloon loan, or the bridge loan rather, out of your current home, out of your current home's equity to be able to put down on the new property.
So literally bridge you from one to the next. So with a bridge loan or one of those programs with the fees, you would make a non-contingent standard conventional offer or FHA or whatever.
Correct. It has, with those buy before you sell programs that charge a fee to allow you to buy before you have to sell, it is a conventional loan only that you can make. There's a guideline on Fannie Mae's guidance, I should say, on their guidelines that that allow for that to happen if you have a backup offer. And what these programs do is they essentially submit a backup offer on your existing home and lock in the
If you don't sell by a certain time, will you buy it?
Yes, so that's how they get around it, but it allows you to waive the contingency off the new purchase.
Does that answer your question, Nate?
You and I have talked about that before already, so
I believe
I
so.
just wanted to confirm all that.
Yes, sir.
You guys, I know, are in a similar boat. Any follow-up questions on that topic? No, pretty good, okay. Okay, cool.
And then after we satisfy any conditions that underwriting needs, we send the file back and they give you the clear to close, and then you guys go to close there. So some interesting don'ts when getting a mortgage. This is always something I always like to cover, just because we don't like our clients making wrong moves that could potentially jeopardize your mortgage loan and chances of buying a home. Things like don't borrow money for your earnest money deposit without telling us.
It's okay to have mom and dad help you, but just let us know.
Don't deposit large sums of cash in your bank account. Don't make a large purchase without telling us before you do it.
No new boats?
Yeah, no. I mean, unless we know about it and we can substantiate
Even
it.
if it's coming from your own company.
Like your company is buying you a vehicle, for example, or
Like a motorcycle.
sounds very specific.
Company's giving out motorcycles, Nate?
Your personal.
You guys hiring? Just say you guys hiring, I could sub out.
So
Yeah,
if
that's a big
the
logo on
business is taking on the debt and not the personal credit, that's fine. But
No, say the business, my business is giving me more money as a bonus or whatever else like that.
that's fine.
Okay, then
Yeah,
that doesn't affect.
we'll have to document it, but we'd have to document it in a certain way, but we can make that work. So, don't max out your credit cards. So we pull your credit initially for the pre-approval, but when we're within a week of closing, we do a soft credit pull or a credit refresh to make sure you haven't went out and bought a motorcycle or bought a
I
boat.
thought you were on my side.
I mean, I am, but these guidelines are just not, unfortunately. And another misconception is, account disputes on your credit report. When you go to get an FHA loan, conventional is not as big of a deal, but if you are in the FHA financing program, you can't have any accounts that are derogatory that you're disputing if it's over $1,000. So if you are disputing accounts on your credit report and you're going to be in an FHA loan, we actually have you go remove those prior to getting under contract.
Oh, that's interesting, yeah. A lot of people do that, you're running your credit for buying a house,
Sure.
you see some things that are wrong, that's great info to know.
And then
Don't close any existing lines of credit, that's interesting. Why wouldn't you want
because
to close
it
that?
can drop.
Negative effect your credit.
Yeah, it can drop your score. And then don't schedule any services before you actually own the home. That's if we're clear to close, I would say you're welcome to go ahead and do that. I just don't pay for things for the house before we actually can get you guys through the loan process, I think is what they're saying.
Awesome.
And here's my contact information. I have some cards back there. Were there any other points that anybody wanted to cover that I haven't talked about? We talked about the
You talk
contingency.
about the business and you're looking at tax returns, but when you actually look at the income, you do look at EBITDA, right? Like the cash flow, not necessarily like, because
So
like
there's
on a
certain
tax
things you can
return,
add
right,
back
you can
in.
make 100K, and if I bought a $100,000 piece of equipment, I can write it off and I show zero income. So it looks like I made no money on my tax return, but really I made 100K.
Right.
It's just a big depreciation write-off.
So there's a formula that we go through depending upon if you're self-employed as an independent, as a sole proprietorship on my personal returns, or if I'm self-employed and I'm showing income on a separate, say, S-corp return or a separate business tax return. Depending on which way it is, there's a formula for each that we would go through. You can add back in things like depreciation. You can add back in mileage driven. You have to take away meals and entertainment. You can obviously add back in net profit. You can add in expenses for the use of your home. So those types of things can get add back in. I imagine like when you, with your example, you bought something that would be somewhere in the depreciation section.
Yeah.
So that could be added back in.
You get the next level questions from a CPA. So.
I love it.
Well, no, I mean, well, for businesses too, I mean, like you want to lower your income tax, obviously.
sure.
But if you're looking to buy a home, I would talk to your accountant and be like, hey, I'm looking to buy a home. Let's not be so aggressive on.
Right. And
Right.
to that point, if you are self-employed, say you just filed 22 and you haven't filed 23 yet, you're on an extension, that's the perfect time to be talking to someone like myself, because I can look at the draft return of 23, compare it to 22, analyze it and say, hey, here's where I think we need to be to get you to qualify for the X home sales price that you're interested in. That way you know how aggressive or conservative you need to be on the return and work with your CPA to get it right so you guys can qualify. Or if not, we have those backup loan options too.
There's two more things as a realtor to also, we want to make sure that they know is don't decide after you're clear to close to quit your job.
That's a big one.
No change of employment.
Don't change your employer in the or or quit your job after you're clear to close, and don't co-sign on anything with anyone for any reason until
It may
after
not
you
seem
get
like
the
a new
keys.
line of credit, but it is.
Yeah.
Yeah, it's a great point.
Another question I get asked all the time, speaking of the job thing, is, how long do I need to be on the job for? So we need a 2-year work history for a W-2 employee, but you don't necessarily have to be on the same job for 2 years. As long as you don't have any large gaps of employment. And as I mentioned, you could start a new job even prior, you can even close prior to starting a new job, as I mentioned, as long as you have the reserve requirements. Yes?
What constitutes a large gap?
Anything over 60 days. Now, you can have large gaps, but so let me give you an example. FHA loans. If you have over a 60-day gap of employment, they want to see a 2-year work history prior to the gap, and then you have your gap, and then after the gap, they want 6 months of reentry to the workforce. And some of it is underwriter discretion, depending upon the reason behind the gap, and we have you sign a letter explaining the reason for the gap. But some of it's discretion by the underwriter. Those are things we piece together during the time of pre-approval. But just because if you have a gap doesn't mean you won't get a loan.
I think we pretty much covered all of the questions. The only thing we didn't really go into too much was the HOA question that Gladys had. Really just an overview of that. About 3 years ago, there was a condo collapse in Miami, the Surfside condo. A lot of the regulations and laws and insurance rules have changed around condominium associations. So some townhomes are set up like a condominium association. So you'll see a lot of condos and townhomes that have a lot of external coverage, or they cover building, stucco, wood siding, frame, etc. Their insurance rates have skyrocketed, or they have to do special assessments to get the property up to code. So it's a great point that a lot of those on single family, when the HOA just covers the common areas, you don't really see a lot of those changing for regulation purposes related to the condo collapse. there were some HOA laws that changed, and about 60% of the country is in an HOA area. So it's pretty popular throughout, but Florida's had some HOA changes for neighborhoods that have actually given less power to the communities. So, you know, it is what it is.
One more thing,
Yeah, go
speaking of the condo front, if anyone is thinking of buying a condo, they can present financing challenges as well. So if you're putting less than 25% down on a condo, we do have to pull a full package of HOA documents from the HOA, talking about their budget, bylaws, community covenants and restrictions. We have to have them fill out a full questionnaire, which is a 4-page questionnaire. That asks them all different kinds of pieces of information from them. If there is anything on any of that documentation that doesn't meet guidelines, it can pose an issue with financing, plus their master insurance. If they don't have the right coverages on their insurance and they're not willing to change their coverages, that can also pose a problem. If you put more than 25% down on a condo, it becomes a limited review where you only need their master insurance and a shortened questionnaire. Makes it a little easier. But you know, less than 25% down, which most people don't put 25% down when they're buying a condo, at least from what I've seen. So we fall into that full review more often than not. The nice thing is though, is one, I have a list of all the Fannie Mae approved condos. So you know, I can know ahead of time what, you know, who has their act together from the HOA side and who doesn't. So that's helpful, but just be wary of condos because they can bring challenges to the table.
Yep, but no, good HOA point for sure. All right, so we've covered a lot of topics, a lot of stuff. We've gone over just a few minutes, but I appreciate you guys. Any last questions? Any follow-up questions? I know we tried to keep it high level. We went into obviously the nitty-gritty on some things. So, but no, otherwise, I appreciate you guys coming in, and we've got some gift cards for you. We got plenty more cookies. Again, I'm not taking them home, so eat them. And like I said, for everybody that attended our Zoom training, we had about a dozen people on there. And then everybody in here, if you work with myself, work with Austin on your next closing, we'll have a closing gift for you guys as well. So can make up to $1,000. So by using it, so bonus for attending today. So yeah, that's it. We appreciate it, guys. Thank you guys very much.
Thanks for your time, guys.
All right, so important stuff.
Like and subscribe.
Target, Starbucks,
Follow our
Dunkin'.
channel.
Who wants what? Target, Starbucks, Dunkin'.
Target.
Target it is.
Hey, awesome.
Yes.
Target, uh-oh.
A lot of people were having problems getting.
I wasn't expecting it to Target. That was awesome.
Did you get close if they were in the house?
It does, but there are some, let's say the roof is just shot.